No doubt you clicked on this video because you want to find AI stocks before the crowd does, not after. And that's exactly what I'm going to deliver. Most investors right now are recycling the exact same AI watch list, names like NVIDIA, Broadcom, Super Microcomputer. Why? Because that's what the algorithm feeds them on a daily basis. Now, I'm not saying these are bad stocks, but in general, most of the overhyped names are trading at bloated valuations. But that's not the case for the 4 stocks I'm going to talk about today. They're still flying on the radar, and most of them are trading for under $30 per share. They're the companies that are actually building the data pipelines, the intelligence layers, and the customer-facing platforms that AI runs on. They're hiding in plain sight, and based on the data, I believe they have incredibly strong momentum and upside potential. In case you're wondering, I'm Steve Reitmeister. I have over 40 years of investing experience, which includes being the former editor-in-chief at Zacks.com. And now I'm a partner at WallStreetZen.com, where I help build a quantitative rating system designed to help everyday investors easily find the best stocks. If you like finding potential hidden gem stocks like these, then please hit that like button below. It tells me to make more videos like this in the future. And by the way, I know you already know this, but investing always carries some risk. Remember to always do your own research before buying any stock. I'm just sharing data here, but ultimately the investment decisions are your own. All right, with all that said, let's dig right in with stock number 1 in DocuSign with a symbol of DOCU. Everyone knows DocuSign is the e-signature company, but that's getting a bit outdated. What most investors are completely missing is DocuSign is reinventing itself as an AI-powered agreement lifecycle platform. And that transformation is further along than the market is pricing in. Now, the stock is still down significantly from its 2021 peak, but there's good reason to believe that things are turning around. DocuSign's Intelligent Agreement Management Platform, also known as IAM, now has 25,000 plus customers, up from just 10,000 a year ago. That's massive adoption. Companies using IAM generate new documents 99% faster, and they reduce the agreement finalization process time by 96%. They also just launched the industry's first purpose-built AI contract agent. It analyzes agreements in seconds, flags all the risk, and surfaces issues for human review. On top of that, their Navigator AI repository now holds over 200 million agreements, right? So no surprise, this is highly desirable for businesses, which explains why they serve 99% of the Fortune 500, right? You got to wonder who the 1% is who isn't on board, right? Wall Street analysts are starting to take notice. Across the 15 analysts covering DocuSign, the average price target implies nearly 40% upside in the year ahead. Now, true analyst targets are just one person's opinion, but it can be a very useful data point. But some are even more bullish. For instance, a top analyst at Citi maintains a buy rating with a price target pointing to up to 100% upside potential in the year ahead. Now, as always, we want to look at stocks through the lens of the Zen Ratings quant model. After considering 115 different fundamental metrics, we have DocuSign as a B-rated stock. That puts in the top 20% of all stocks we track, which is a solid B recommendation. Drilling down into the Zen component grades, we see a few interesting things. For one, this is the highest AI factor rating in this video, scoring the top 3% of all stocks. Our proprietary algorithm sifts through 20 years of market data to detect subtle patterns that point to greater likelihood of outperformance, meaning this is a potential timeliness signal that the stock is ready to move. Financial strength is another standout area for DocuSign, leading to an elite A rating. That's because the company has ample cash with nearly no debt to speak of. This is allowing them to embark on an aggressive $2 billion share repurchase program. The value component ranks in the top 10% based upon 21 different value measures. This suggests the stock is also severely underpriced, probably why they want to embark on the $2 billion share repurchase program. This is the most contrarian name on the video today. The market appears to be ignoring it, all the while our model, looking at the full picture of its fundamentals, says it has the makeup of a stock that is much more likely to outperform going forward. Now, some of the risk. If the IAM adoption doesn't accelerate faster than expected, then the stock could stay in the penalty box. Revenue growth is also modest in the mid-single digits camp. That may be distracting some investors from the bigger picture. But remember, the DocuSign has the highest AI readiness score in this video, a fortress balance sheet, a solid earnings growth, and is still trading at pandemic crash levels. While the market looks the other way, our system says to back up the truck, given the exciting upside potential. Now we roll on to stock number 2 in LiveRamp Holdings with a symbol of RAMP. LiveRamp is a company many investors have never heard of, but it quietly powers the data layer behind AI-driven marketing. If AI advertising is the engine, then LiveRamp is the fuel line. All right, LiveRamp operates one of the largest privacy-safe identity graphs, connecting first-party data across clouds, partners, and platforms. Now, it's expanding to an AI-focused data hub where clients can license permissions data to train models, access third-party AI, and deploy applications. At the same time, they maintain governed audible controls. Financially speaking, the story is getting quite compelling. LiveRamp Holdings is delivering record-level margins while continuing to expand free cash flow, signaling improving operating leverage. Management is explicitly targeting Rule of 40 performance for 2028, which would put them in elite SaaS territory for operational excellence, right? SaaS, software as a service, right? This is not a hollow pledge. They are so confident in this positive business outlook. They are committed to an aggressive 1.5 billion share buyback, right? And this isn't that big of a company, so that's a very large commitment. The combination of margin expansion, disciplined capital return, and a clear profitability roadmap suggests that they are becoming a high-quality, cash-generating business. Now, the Zen Ratings concurs with this view as Ramp ranks the second best company in the entire software infrastructure industry. Even better, the company ranks in the top 1% of all stocks in the model, meaning it is outperforming 99% of the 4,600 stocks evaluated by the entire Zen Ratings quant model. Not surprisingly, it scores well across a wide range of the Zen component grades. Growth and value are the clear standouts, placing the top 6% and 7% respectively. Then we have a top 20% showing across safety, financials, and the AI timeliness factors. That is a well-rounded fundamental profile that typically attracts more investor interest over time. On the risk side, revenue concentration is something we need to watch here. Right? A small number of large enterprise clients account for a meaningful portion of revenue, so losing even one of them could have material impact on the results. And competition exists. Google and Adobe both operate in adjacent areas with significantly more resources at their disposal. But fundamentally strong LiveRamp is a picks and shovels AI play most investors haven't even discovered yet, but probably should given the high potential of future outperformance. By the way, if you're liking these picks so far, then please subscribe and hit the notification bell. That's because I release stock pick videos like this several times per week. And subscribing is the best way to guarantee you don't snooze and lose on the next time around. Okay, 2 stocks left to go, which brings us to stock number 3 in IBEX Limited with a symbol of IBEX. All right, the company has quietly built one of the most compelling AI transformation stories in the market. Amazingly, the share price doesn't reflect any of that. If you're not familiar, then let me explain what IBEX does. It's a global customer support company. They have over 38,000 human agents combined with a proprietary AI platform. In real time, this platform determines the best customer experience, automated versus live agent. Looking at the results, it's clear IBEX isn't just growing, they're on a legitimate tear. This is the 4th straight quarter of double-digit revenue expansion, this time rolling up to 17% year-over-year growth in just revenue alone. Even better is it translated into 45% earnings growth. That is a masterclass in operating leverage. They aren't just getting bigger. They're getting significantly better at dropping more dollars to the bottom line over time. In addition to that, IBEX has a 98.5% customer retention rate. Let that sink in for a second. They basically don't lose clients, and thus each new one they add helps fuel the next level of growth. On the Wall Street side, this is a classic under-the-radar setup. Only one analyst covers IBEX, and he is looking for 40% potential upside for shares in the year ahead. Of course, one analyst take isn't the gospel, but the optimistic forecast is worth noting. I believe that as more investors discover the IBEX growth story, the more buy recommendations will emerge from Wall Street, and each one helping to potentially push shares higher. The Zen Ratings picks up what IBEX is putting down. That's because they received a coveted A rating from our model. Now, not only is it the top-ranked stock in the crowded IT services industry, but is also in the top 3% of all stocks ranked by the entire model. Looking at the component grades, that makes for an overall rating, the value component really stands out. In fact, it's in the top 5% of all 4,600 stocks analyzed by the model. The recent sell-off in the software sector, combined with geopolitical uncertainty, has pushed the stock down by more than 25% as of this recording. That pullback suggests a potential buy-the-dip opportunity, especially relative to what the business is actually delivering on the growth side. And what's delivering is impressive financial strength and growth, which also shows up in the Zen Ratings model. IBEX clearly distinguishes itself from its peers, generating roughly 2x the industry average in key metrics like return on capital employed and return on assets. Our proprietary AI component assigns a B rating for IBEX that places in the top 20% of all stocks our system has flagged as timely outperformers in the coming months ahead. In terms of risks, there are a few to keep in mind, like the others in the space. IBEX faces potential disruption from AI, which could pressure the traditional business model as clients bring operations in-house. However, with an A-rated value profile, strong AI integration, and record-level financial performance, this is exactly the type of attractive stock our system is designed to uncover. Before we get to the last pick in the video today, a little quick reminder. Every Monday, I share my stock of the week with investors. This blends the outperformance found in the Zen Ratings quant model, along with my greater than 40 years of investing experience. So get my future stocks of the week for free by clicking the link in the description or scanning this QR code. Now let's close out with stock number 4 in MNTN, Incorporated, with a symbol of, you guessed it, MNTN. All right. Indeed, I saved the best for last because the company is making TV advertising work like Google search. Not impressed? Well, how about this? I happen to notice that prominent Wall Street analysts currently forecast over 130% potential upside for shares in the coming year. Okay, got your attention? We will get back to that in a moment. But first, a little background on the company. Their AI platform allows any business to run performance-driven TV campaigns with the same targeting and measurability as digital ads. And here's the stat that's interesting. 97% of the brands using MNTN have never advertised on TV before. What? They are 97%. They are truly unlocking a totally new market, which spells tremendous growth opportunity. The recent quarterly results prove this out, with revenue climbing 36% year over year. Here again, that's revenue. Even more impressive is going from a $4 million loss to a $35 million profit. And recent news indicates there's more of that to come in the future. MNTN just launched QuickFrame AI. This enables users to create TV ads in minutes using Google and 11 Labs. And they recently partnered with Magnite, unlocking premium streaming and live sports inventory that taps into a $90 billion TV ad market. On the Wall Street analyst side of things, this is where MNTN really stands out. That's because it's rare to see Wall Street so bullishly aligned. In this case, we're talking about 7 of the 8 covering analysts recommending the stock is either a buy or a strong buy. And as I already shared, the average target price implies 130% upside for shares. Even better is the street high target. Here we're talking about 190% potential upside in the year ahead. The group of analysts includes some heavyweights like Laura Martin of Needham. She is ranked in the top 2% of analysts based on her stellar stock picking performance. When analysts with such a strong track record are so bullish on a stock, it pays to listen. As I mentioned at the start, MNTN is the highest rated stock among the picks in the video today. On a scale of 1 to 100, it earns a 99.4 score from the Zen Ratings system, meaning top 1% of all stocks based upon the full review of 115 different fundamental metrics. And it's backed by impressive component grades. Financial strength is its strongest area, ranking the top 1% of all stocks. That's because the company carries nearly no long-term debt and operates a highly efficient cash-generating machine. Sentiment is another A-rated category as the institutional money is flowing in and Wall Street analysts are very, very positive. Value is solid as well, with the B rating putting in the top 20% of all stocks. Note that the share price has dropped significantly since its IPO last May, creating what may be an attractive entry point at this time, truly a buy-the-dip opportunity. On the risk side, you should know that advertising is a cyclical business. Any budget cuts or broader economic weakness would certainly impact demand going forward. CTV is also still proving itself out as a must-have channel. And as a small-cap company itself, volatility is going to be higher. Lower float means bigger swings in both directions. Sometimes it also means it swings higher faster. With all that being said, we're talking about a tremendous growth story that I believe is severely undervalued. Both Wall Street analysts and the Zen Ratings model point in that same direction. So if you're interested in hidden gems, then start researching this one as soon as possible. Today, I covered 4 companies, each flying under the radar of the market, each using AI to reshape their industries, each getting love from Wall Street top analysts and the Zen Ratings quant model. Meanwhile, the stocks dominating your feed are much less impressive. Lower ratings and higher valuations, that's a pretty bad combination. Spotting these under-the-radar stocks is nice. Acting on them before the rest of the crowd does is even nicer. And if these undervalued AI stocks resonated with you today, then you should check out my next video featuring 3 stocks to consider buying on the dip and 1 to avoid at all cost.